The exact date of the next stock market crash is not written on any calendar. It is not announced by financial institutions, and it will not appear in tomorrow's headlines. Yet, it exists, hidden inside liquidity patterns, buried within bank reserve data, and concealed in the behavior of those exiting while others are still entering. The last two times this exact sequence appeared, investors remained confident until they weren't. By the end of this analysis, the question will no longer be if the crash comes, but whether the warning was recognized before the date became undeniable. Welcome to Currency Analyzer, a space where economic reality is examined without the noise, without the theatrics, and without the comfortable lies that financial media prefers to tell. If this is your first time here, consider this not an invitation to entertainment, but to understanding. Now, before we continue, there is something that would help this work reach those who need it most. If you have seen enough market cycles to recognize patterns, if you remember when financial advice was built on analysis rather than algorithms, if you believe that serious economic discussion still has value in a world drowning in headlines, then take a moment and subscribe to this channel. Not because it is fashionable, but because structured economic analysis, the kind that examines systems rather than chasing trends, is becoming rare. And one more thing, drop a comment below and let us know, where in the world are you watching this from? What market conditions are you observing in your region? Because economic pressure does not move uniformly across borders, and your perspective, your experience, adds critical context to this analysis. Now, let us begin. The exact date of the next stock market crash is not something that appears on financial calendars, and it is not something that analysts announce weeks in advance, but it is something that can be identified quietly, methodically, long before panic ever surfaces. Right now, at this very moment, markets appear calm. Stock indices hover near record highs. Volatility remains subdued, and most investors believe the worst has already passed. Yet the most critical signal, the one that has preceded every major collapse in modern financial history, is not found in stock prices. It is not found in corporate earnings reports or in economic forecasts. It is hidden inside liquidity, inside the behavior of central banks, inside the reserve levels of commercial banks, and inside the calculated exits of those who understand what comes next. History has shown this pattern before. In the late 1990s, investors were confident until suddenly they were not. In 2007, the system appeared stable until it fractured within weeks. In early 2021, markets reached euphoric heights, only to enter a prolonged decline that destroyed trillions in wealth. Each time, the warning signs were present months in advance. Each time, they were ignored by the majority. Each time, those who recognized the pattern positioned themselves differently, while others continued buying at the peak. And now, that same pattern is forming again. The Federal Reserve, the Central Bank of the United States, and one of the most influential financial institutions in the world, has quietly restarted money creation. This is not a future policy under discussion. This is not a theoretical response to potential problems. This is an active operation happening now. Approximately $40 billion per month is being injected into the financial system. The institution does not call this quantitative easing, but the effect is identical. The central bank is expanding its balance sheet again, after nearly 2 years of attempting to reduce it. That reversal alone, that single policy shift, changes the entire structure of risk in global markets. But why does this matter? Why should business owners, entrepreneurs, and investors pay attention to technical details about central bank balance sheets? Because the reason behind this money creation is not economic strength. It is economic stress. Bank reserves, the actual usable cash that financial institutions hold to meet daily obligations, have fallen to multi-year lows. Emergency lending facilities, designed to provide support during crises, have experienced record usage. In simple terms, banks have been running short on liquid capital. When this happens, when the banking system begins to show signs of strain, the entire financial structure becomes fragile. The central bank does not inject liquidity because conditions are strong. It acts because something in the system is approaching a breaking point. This distinction is critical. Most market participants see rising stock prices and assume everything is functioning normally. They observe low volatility and believe risk has been contained. They watch financial media celebrate new highs and conclude that the economy is healthy. But liquidity injections during apparent stability are not signs of strength. They are warnings. They indicate that behind the surface, beneath the calm exterior of rising indices and confident headlines, structural problems exist. Problems serious enough to require continuous intervention. The pattern that precedes every major market collapse follows a specific sequence. First, economic stress appears in parts of the system that most people do not monitor. Bank reserves decline, credit markets tighten, and liquidity begins to fragment. Second, central banks respond with support measures. Money is created, injected into the financial system and distributed through banking channels. Third, the newly created money flows into asset markets. Stocks rise, real estate appreciates, and speculative investments attract increasing capital. Fourth, insiders begin to exit. Those with the deepest understanding of market mechanics, those with access to private information about company conditions, begin selling their holdings, not all at once, but systematically, transferring risk to new buyers who are entering at elevated prices. Fifth, the reversal begins. Liquidity stops expanding, confidence peaks, and the accumulated imbalances can no longer be sustained. The adjustment that follows is not gradual. It is sudden, severe, and painful for those who were unprepared. This sequence is not theory, it is historical fact, documented across multiple market cycles, visible in data that remains publicly available for anyone willing to examine it. And right now, the first three stages of this sequence have already occurred. Economic stress has appeared. Central bank support has been activated. Asset prices have risen in response to liquidity injections. The fourth stage, the phase where insiders begin systematic exits while public participation increases, is forming now. The question is not whether this pattern will complete. The question is whether observers recognize it before the fifth stage makes recognition irrelevant. There is a fundamental misunderstanding about how modern banking actually operates. Most people believe that when they deposit money into a bank, that money remains there, waiting, available for withdrawal at any moment. This belief, while comforting, is completely incorrect. The moment money enters a bank, it disappears, not literally, but functionally. It is lent out, almost immediately, to borrowers who then spend it, creating the illusion that two people now have access to the same money simultaneously. The depositor sees a balance on their screen. The borrower receives actual funds to purchase a house, expand a business, or finance consumption. Both believe they have money. But in reality, only one pool of actual currency exists, while two claims have been created against it. This is not a flaw in the system. This is the system. It is called fractional reserve banking, and it has been the foundation of modern finance for over a century. Under this structure, banks are required to hold only a fraction of deposits as reserves while lending out the remainder. Historically, that fraction was 10%. If a bank held $1 million in deposits, it was required to keep $100,000 available while lending out $900,000. But in March of 2020, during the early stages of the global pandemic, the Federal Reserve made a decision that fundamentally altered the stability of the entire banking system. It reduced the required reserve ratio to zero. Zero. Banks in the United States, the largest economy in the world, are now allowed to lend out every single dollar they receive in deposits. There is no buffer, no mandatory cushion, no structural protection against a sudden loss of confidence. The system now operates on one condition alone: trust. As long as depositors trust that their money is available, as long as they do not all attempt to withdraw simultaneously, the system functions. But the moment that trust fractures, the moment a significant number of depositors decide they want their actual money back, the entire structure begins to collapse. And this is not theoretical speculation. This happened recently, in plain view. In March of 2023, one of the largest banks in the United States failed, not over months, not after prolonged warnings. Within 48 hours, the bank held over $200 billion in assets. It served thousands of businesses, startups, and high net worth individuals. It was considered stable, well managed, and financially sound, until it was not. The collapse began when depositors, many of them business owners and entrepreneurs, began questioning the bank's liquidity. They did not question whether the bank had assets. They questioned whether those assets could be converted to cash quickly enough to meet withdrawal demands. The bank held long-term bonds, purchased when interest rates were near zero. When rates rose dramatically, the value of those bonds fell. On paper, the bank was solvent, but in practice, it could not access enough liquid cash to satisfy depositors who wanted their money immediately. Word spread, not through traditional media, but through private networks, text messages, and encrypted communication channels. Within hours, withdrawals accelerated. Within a day, the bank was attempting to raise emergency capital. Within 2 days, regulators seized control. The speed was unprecedented, but the mechanism was not. This is how modern bank failures occur. Not through traditional insolvency, but through liquidity crises. The bank does not run out of assets. It runs out of the ability to convert those assets into immediate cash faster than depositors are demanding it. And here is where the connection to broader markets becomes critical. When the Federal Reserve injects $40 billion per month into the banking system, it is not doing so to stimulate economic growth. It is doing so to prevent exactly this type of collapse from spreading. Bank reserves, the actual cash that banks hold at the central bank, had fallen to dangerously low levels. Emergency lending facilities, programs designed to provide liquidity during crises, were being utilized at levels not seen since the height of the financial crisis in 2008. The central bank recognized that the system was becoming fragile, so it began creating money again. But this newly created money does not stay in bank vaults. It flows outward, seeking return. Banks that receive this liquidity do not simply hold it. They lend it, invest it, and deploy it into markets where yields can be captured. Much of this capital flows into asset markets, stocks, real estate, corporate bonds, speculative investments. This creates artificial demand. Prices rise, not because underlying businesses have become more valuable, but because more money is chasing the same assets. This is why markets often rally when central banks inject liquidity, even when economic conditions are deteriorating. The money has to go somewhere. And in a world where traditional savings accounts offer minimal returns, where bond yields remain historically low, where inflation erodes purchasing power, capital flows into assets that appear to offer growth. This creates a feedback loop. Rising prices generate confidence. Confidence attracts more capital. More capital pushes prices higher still. Eventually, a narrative emerges to justify the valuations. In the late 1990s, the narrative was the internet revolution. In the mid-2000s, it was real estate and financial innovation. In 2021, it was disruption, remote work, and digital transformation. Today, the dominant narrative is artificial intelligence. These narratives are not false. The technologies are real, the potential is genuine, and the long-term impact will likely be significant. But narrative and valuation are not the same thing. A technology can be revolutionary, while the companies built around it remain overpriced. And this is where the business community must exercise caution. Because when liquidity-driven rallies reach their peak, when confidence is at its highest, when narratives have convinced the majority that risk has disappeared, that is precisely when insiders begin to exit, not with announcements, not with public statements, but through quiet, systematic, perfectly legal transactions that transfer ownership from those who understand market mechanics to those who believe the rally will continue forever. There's a moment in every market cycle that almost no one recognizes while it is happening. It is not dramatic. It does not arrive with breaking news, emergency announcements, or panic selling. It arrives quietly, disguised as normalcy. Prices continue rising, sometimes even reaching new highs. Confidence remains intact. Analysts maintain optimistic forecasts, and financial media continues celebrating success stories. But beneath the surface, something fundamental has changed. Liquidity, the force that propelled prices upward for months, has stopped accelerating. It has not disappeared, it has not reversed. It has simply stopped growing at the rate required to sustain momentum. And this distinction, this subtle shift from expansion to mere maintenance, changes everything. When markets rise because new capital is flooding in aggressively, that is strength. When markets rise because selling pressure has not yet materialized, that is fragility. One is built on incoming force. The other is built on the absence of opposing force. The difference appears minor, but it determines whether a market can withstand unexpected shocks or whether it collapses the moment confidence wavers. Right now, global markets are operating in the second condition. They are not rising because of overwhelming new demand. They are holding elevated levels because large-scale selling has not begun yet. For businesses, this shift manifests in ways that most executives do not immediately connect to broader market conditions. Access to capital, which felt abundant just months ago, becomes uneven. Companies with strong balance sheets, established revenue, and predictable cash flow still receive financing easily. But businesses operating on projected growth, those dependent on continuous funding rounds, those with high burn rates and uncertain timelines to profitability, suddenly face questions they were not asked before. Banks begin tightening lending standards, not through public announcements, not through policy changes that appear in headlines, but through internal risk assessments, through marginally higher interest rates for certain borrowers, through slightly more restrictive covenants in loan agreements. Applications that would have been approved 6 months ago now require additional documentation. Credit lines that were automatically renewed now face closer scrutiny. Terms that were previously negotiable become fixed. This tightening happens quietly, bank by bank, loan by loan. And for the businesses experiencing it, it feels isolated, like a problem specific to their situation, but it is not isolated. It is systemic. Meanwhile, inside the private companies preparing to enter public markets, urgency intensifies. Advisors who once discussed optimal timing now emphasize immediate action. Valuation conversations that focused on long-term potential now center on current market appetite. The language changes. Instead of, let us wait for the perfect moment, it becomes, conditions may not remain this favorable. Instead of, we can afford to be selective, it becomes, We need to move while demand exists. Now, this urgency is not driven by fear of business failure. These are often successful companies with real products, real customers, and real revenue. The urgency exists because sophisticated advisors understand something that the general public does not. Windows of opportunity in capital markets do not stay open indefinitely. They close suddenly and without warning. And when they close, they remain shut for years. The companies that complete their public offerings during the final months of favorable conditions succeed. Those that delay, those that wait for slightly better terms, those that believe the window will remain open just a bit longer, often find themselves trapped, unable to access public markets. Forced to raise capital privately at significantly worse valuations, or worse, unable to raise capital at all. For public market investors, this phase produces confusion. Markets no longer respond to positive news the way they once did. A company reports better than expected earnings, and the stock barely moves. Economic data shows continued growth, and indices decline. Central banks signal continued support, and volatility increases rather than decreases. Every positive development now carries an implicit question. If conditions are strong, why is support still necessary? If growth is solid, why are banks tightening? If the future is bright, why are insiders selling? These questions do not have comfortable answers. So most investors choose not to ask them. They continue holding positions, not out of conviction, but out of inertia. They tell themselves the uncertainty is temporary. They convince themselves that any pullback will be minor and quickly recovered. They wait for confirmation that the trend remains intact. But confirmation never arrives in the expected form. Instead, something else begins to happen. Trading volume changes character. Long-term institutional investors, the pension funds, endowments, and sovereign wealth funds that typically provide market stability become less active. Their buying, which once absorbed dips and supported rallies, diminishes. At the same time, short-term traders, algorithmic systems, and speculative participants become more dominant. This increases volatility even when index levels remain elevated. Prices swing more dramatically on less significant news. Moves that once took weeks now occur in days. And these swings, these sudden jolts up and down, create the illusion of opportunity. Traders see movement and assume profit potential. But what they are actually witnessing is the deterioration of market structure. The ownership base is shifting. Long-term capital is quietly reducing exposure, and the capital replacing it is shorter term, more reactive, and far less stable. This is also the phase where insider selling becomes statistically significant. Executives and early investors, whose shares were previously locked from sale, now have the ability to exit. They do not sell everything at once. That would be too obvious, and potentially damaging to the stock price. Instead, they sell methodically, small percentages, spread across weeks and months, through pre-planned trading programs that provide legal cover. The selling does not crash the stock. It simply absorbs demand. Every share they sell is purchased by someone else, often a retail investor who believes they are buying at a reasonable price, but the transaction represents a transfer. Risk is moving from insiders who understand the company's true vulnerabilities to outsiders who believe in the publicly presented narrative. And here's the critical point that most people miss. This is not unethical. This is not illegal. This is how capital markets function. Insiders are allowed to sell. They are required to disclose those sales, but disclosure does not prevent the transaction. And while each individual sale might be justified by personal financial planning, estate management, or diversification, the aggregate pattern tells a different story. When insider selling across an entire market increases significantly, when lockup expirations cluster within a narrow time frame, when secondary offerings multiply across sectors, it indicates that those closest to actual business conditions are choosing liquidity over continued ownership. They are exiting, not because they believe their companies will fail, but because they understand that current prices reflect optimism, not reality, and they know, from experience, from observing previous cycles, from understanding how liquidity-driven markets operate, that optimism does not last. The system is now in a state of maximum sensitivity. Any unexpected event, any policy miscommunication, any piece of economic data that contradicts the prevailing narrative carries the potential to trigger disproportionate reactions, not because the event itself is catastrophic, but because the market structure has become fragile. Confidence is high, but it is also brittle. It can shatter quickly, and when it does, the adjustment will not be gradual. By the time the broader public recognizes that something has changed, the system is no longer deciding what might happen. It is deciding how severe the adjustment must be. Markets at this stage are not responding to new information. They are repricing assumptions. Assumptions that were formed during a period when liquidity felt permanent, when central bank support seemed guaranteed, And when risk appeared to have been eliminated, those assumptions are now being tested, and they are failing. What follows is often misunderstood. People expect panic first, followed by falling prices. But that is not how market collapses actually unfold. Prices fall first, panic arrives later. The initial decline is rational. Investors reassess what they are willing to pay for future earnings that now appear less certain. Valuations compress as risk premiums widen. Growth projections are revised downward. Multiples that seemed justified weeks earlier now appear excessive. This phase feels controlled. Many participants believe it is temporary, a healthy correction, a brief pause before the upward trend resumes. Financial commentators use phrases like profit-taking and consolidation. Analysts issue statements reminding investors to stay calm and focus on long-term fundamentals. But beneath this calm exterior, pressure is building. Because in a system built on leverage, small price declines trigger forced actions. Margin calls are issued. Risk management systems activate automatically. Positions must be reduced. Not because investors have changed their minds about long-term potential, but because the system removes choice. When an investment portfolio falls below certain thresholds, brokers demand additional collateral. If that collateral is not provided immediately, positions are liquidated automatically. The investor's opinion becomes irrelevant. The sale happens regardless. And when these forced sales begin occurring across thousands of accounts simultaneously, selling pressure compounds. Each sale pushes prices lower. Lower prices trigger additional margin calls. Additional margin calls force more selling. The cycle feeds itself. This is where leverage, which magnified gains on the way up, now accelerates losses on the way down. For hedge funds managing billions in assets, this moment is particularly dangerous. Many operate with sophisticated strategies that depend on stable correlations between different assets. When volatility spikes and correlations break down, those strategies fail. Losses that were supposed to be impossible according to risk models suddenly materialize. And because these funds often borrow heavily to amplify returns, even small losses can threaten their survival. They are forced to sell, not just losing positions, but winning positions as well. Anything liquid must be sold to raise cash, to meet redemptions, to satisfy lenders. This is why market declines accelerate so dramatically once they begin. It is not because everyone suddenly changes their fundamental view. It is because the structure of modern finance forces selling, regardless of individual beliefs. Banks experience this pressure differently, but no less severely. Collateral that secured loans days earlier is now worth significantly less. Borrowers who appeared creditworthy are now struggling. Loans that were extended during optimistic conditions are now showing signs of stress. The bank's own portfolio, filled with bonds and securities purchased when markets were rising, is now declining in value. If depositors become concerned, if withdrawal requests increase, the bank faces the same problem that destroyed institutions in 2023. Assets exist, but they cannot be converted to cash quickly enough. For businesses, particularly those that expanded aggressively during favorable conditions, this environment is brutal. Projects that were greenlit when capital was cheap are suddenly questioned. Expansion plans are paused, hiring freezes are implemented, non-essential spending is eliminated immediately. Cash flow, which was treated as secondary to growth during the boom, now becomes the only metric that matters. Companies that relied on continuous access to capital markets discover that those markets have closed. Initial public offerings are postponed indefinitely. Follow-on offerings are canceled. Private funding rounds that were expected to close easily do not close at all. And for businesses with high burn rates, those that were spending aggressively to capture market share, to scale operations, to outcompete rivals, the clock starts ticking. How many months of runway remain? Can expenses be cut fast enough? Will revenue hold steady? Or will it decline as customer sentiment weakens? These questions have no comfortable answers. Some companies survive through discipline, through having maintained cash reserves, through having avoided excessive leverage. Others do not. Layoffs are announced, offices are closed, partnerships are dissolved, and in the most severe cases, bankruptcy filings begin. Meanwhile, public perception shifts dramatically. The same financial commentators who dismissed concerns weeks earlier now explain why the collapse was inevitable. The same analysts who maintained buy ratings now issue reports detailing structural problems they claim to have identified. Hindsight becomes universal. Everyone suddenly knew it was coming. Everyone claims they saw the warning signs. But the data tells a different story. Trading records show that most investors were fully exposed, right up until the decline began. Insider selling data shows that those with the most information exited months earlier. And public sentiment surveys reveal that confidence remained high until suddenly it did not. This is where the concept of an exact date becomes emotionally significant. People want a moment to blame. A specific announcement, a policy decision, a geopolitical event. They want to point to something external and say, that is when it happened. But market collapses do not work that way. The date that appears in headlines is not the cause. It is the result. It marks the moment when accumulated imbalances could no longer be sustained, when the gap between price and value became too large to ignore, when liquidity could no longer mask underlying fragility. Historically, this moment aligns with a convergence of factors rather than a single trigger. Central bank support slows or stops completely. Insider selling reaches peak levels. Economic data weakens just enough to shift expectations. Political uncertainty increases. None of these alone causes the downturn, but together, they remove the final layer of confidence that was holding the structure together. At this stage, policy responses are expected. Governments signal willingness to intervene. Central banks hint at renewed support. Emergency measures are discussed. But policy operates with delay. By the time decisions are made, implemented, and begin affecting real economic conditions, markets have already adjusted, prices have already fallen, damage has already been reflected in portfolios, in business valuations, in retirement accounts. And this is where the uncomfortable truth emerges. Crashes are not anomalies. They are not system failures. They are structural resets. They occur because markets were pushed beyond sustainable balance. Liquidity delayed the adjustment, but it also magnified the imbalance. The longer the delay, the sharper the eventual correction. For those who understand this, who recognize the pattern while it is forming rather than after it completes, the approach is different. They do not attempt to predict the exact day or week. They assess where the system is vulnerable. They evaluate their own exposure. They reduce risk when conditions are most favorable, not when prices are already falling. They prioritize preparation over prediction, because the exact date, when it finally arrives, will feel obvious in hindsight. Everyone will claim they saw it coming. But portfolios will tell the real story. Some will reflect decisions made wisely, months in advance, when exits were still available. Others will reflect decisions made impulsively during the decline, when options were limited and losses were unavoidable. The market does not reward awareness after the fact. It rewards preparation that came before. And that is the quiet truth behind every major market collapse. The outcome is decided long before the event. The only question is, who recognized the pattern early enough to act, and who realized it only after the adjustment was complete? The signal was always there, hidden not in secrecy, but in plain sight, visible to those who chose to watch liquidity instead of headlines, to those who understood that crashes do not announce themselves. They arrive after confidence peaks, after exits close, after preparation time has passed. The exact date was never the question that mattered. The question was always, who saw the pattern and who acted on it before the calendar made it undeniable? If this analysis provided clarity that financial media will not offer, if it shifted perspective from reaction to preparation, then share it with those in your business community who value structure over speculation. Leave a comment below, not with predictions, but with observations. What are you seeing in your market? What signals are appearing locally that align with this pattern? And if this type of content matters to you, if you believe that serious economic analysis still holds value in a world dominated by noise, subscribe to Currency Analyzer, because the next phase of this cycle will not wait for permission. It will simply unfold, and those who understand the mechanics will navigate it differently than those who only react to outcomes. Until the next analysis, stay structured, stay prepared, and stay aware.